All right, today is Monday, May 24th. This is a recap for the stock market activities today. What do you know? We're gapping higher again on very low volume. The market gets pumped overnight and faces very little resistance during the trading hour. And therefore, the path of least resistance during low volume days is higher. We are coming to the end of the month. And of course, portfolio managers don't want to look bad at the end of the month. This is how they receive their bonuses. And of course, as a result, it is not a surprise that usually, not always, but usually, the last week of trading in the month happens to be a positive one. We will see. Of course, we have 4 more days remaining before the end of the week. In the process of trading higher today, the market managed to do a lot of technical repairs, at least for the indices from a daily charts perspective. And I will show you that during the charts analysis. The other thing I want to talk about is combine the low volume that we had today with the lack of any activities on the economic calendar. Today we had nothing, absolutely nothing on the economic calendar. Matter of fact, we're not going to have anything important all the way until Friday. And therefore, the path of least resistance for the market right now, all the way till Friday, is higher. But this risk tolerance and buying the dip will be tested the moment we head on and we receive more economic data regarding inflation. And the market cares about inflation data to assess the prospects of tapering. This is what the market is worried about. It's all about tapering. Another point I want to talk about is the importance of Bitcoin to the entire market. For example, over the weekend we saw a massacre, but today it was a rebound day for Bitcoin. And right away you saw stocks rebounding higher along with Bitcoin. And led by what? Led by stocks associated with Bitcoin. We're talking about Tesla, we're talking about Square, we're talking about PayPal, ARK Invest. All of these names had a phenomenal day. The problem is Bitcoin is becoming extremely volatile. It always been this way, but the level of extreme volatility that we have witnessed the last few weeks is unprecedented. And therefore, that adds another risk element to the market. And that leads me to de-risking. We talked about de-risking last night. And I talked about using option strategies to de-risk. And a lot of you asked me to give examples and expand more on how to de-risk using option strategies. Here are 3 option strategies that every stock market investor should know about. Because these strategies are not only vehicles for de-risking, but also in certain instances, and I will demonstrate that for you, you can actually make money whether the stock goes up, down, or nowhere at all. You win either way. How could you not like that? And I will show you real-life examples from my own portfolio. These are moves that I've already taken, and I will share those with you. But before we start, here's a disclaimer. If you are new to options, understand this. Options are proxies for stocks. Each option represents 1 share in a stock, but options are traded in contracts, and each contract has 100 options, meaning that every contract you trade in terms of options is representative of 100 shares. This is important to understand because options come with the obligation of exercising upon the expiration date, assuming that these contracts were not closed prior to expiration date. This is important because you cannot buy and sell what you don't have. Meaning, if you are trading 10 contracts, meaning 1,000 shares, yet you do not own 1,000 shares of the underlying stocks, nor do you have the amount of money needed to trade 1,000 shares of the underlying stock, you will be in a lot of trouble. I'm not trying to scare you if you're a newbie to options, but you have to understand that options are proxies for stocks, and options are traded in contracts. Each contract has 100 options. So when you trade one options contract, you're basically trading 100 shares of the underlying stock. This is all what you need for now, for the purposes of this video, because we're talking about de-risking strategies. You are a stock market investor and you are trying to use option strategies to de-risk your portfolio. The traditional way of de-risking is taking profits off the table. But what if that is not an option for you? Say for taxation reasons, or you're not sure that there is a correction looming, you don't want to sell and regret later, etc., etc. Therefore, these option strategies become extremely important. And here it is. Strategy number 1, buying naked puts. Here is a stock in my portfolio, Microsoft, and the chart is clean, no markings or annotations by me. Now, since I bought the stock, I am up about 20% or so, at least when the stock was trading at the highs. What if Microsoft, for whatever reason, starts to trade lower? And we know in normal behavior in the stock market, forget the bubble, but in normal behavior, stocks take the escalator up, but they take the elevator down, meaning that the flush downs are very surprising and they are very steep. You can lose your gains quickly. It can take months to build your gains only to lose them all together in a matter of days during a steep correction. And therefore, de-risking is important. So in this case, my risk tolerance is 10%, meaning I want to maintain a 10% profit margin. I'm okay with Microsoft going down, but I want to lock 10% gains. I'm now up over 20%. If the stock goes down another 10%, that's okay. That is my risk tolerance. I'm okay with that. But if the stock starts to go lower than that, and now my profit is down to 8, 5%, what if the position starts to lose money? I don't want to be in that situation, and therefore, I want to buy an insurance policy. I want to lock my profit at 10%. This is my risk tolerance. Therefore, when the stock was trading at all-time highs, and I saw that big red reversal candle, I started buying the 235 puts because at 235, I am still up 10% or a little more. But if the stock starts to trade below 235, then I'm not okay with that because I want 10% profit margin. This is the minimum. And therefore, I bought the 235 puts, expiring in August, meaning that my insurance policy will protect me if the stock goes down below 235 all the way till August expiration. And the reason is, while your stock position is losing money, your put options are appreciating in value. And the beauty of doing this strategy is, let's say I own 100 shares of Microsoft. That means to protect 100 shares of Microsoft, I need one put options contract. Because remember, each contract has 100 options. Each option is a representative of one share. But the beauty of doing this strategy is you are not bounded to buy just one contract. You can buy 2 contracts, 3 contracts, 5 contracts, it doesn't matter. And therefore, you're not just going to be protected from a downside if Microsoft starts to trade below 235. Because what is the point of substituting your stock losses with option gains? That is not satisfactory for me. I want to make money when the stock goes to the downside. And therefore, while in this example I have 100 shares of Microsoft, I bought 5, 6, 7 put options contracts. And therefore, if the stock goes below 235, I will actually be making a lot of money. The catch is, once you see Microsoft bottoming before the expiration date and turning around, you start closing these contracts. Because if you leave them open and they expire in the money, meaning Microsoft is trading below 235 by expiration date, you will be obligated to exercise those put options. When you exercise those put options, you are now going to be short the stock. So you don't want to be in that situation. You use the put option contracts as insurance. The stock drops below 235. It starts to bottom and turn around. You close those contracts and you book the profits. And now if you want to buy the dip in Microsoft, that's up to you. But you have a lot of money that you have made from buying those put options. The last thing to mention about this strategy is that it works best if you buy the insurance policy before the stock starts to break down. Because if the stock starts to break down, you're Johnny come lately. Those premiums you're going to have to pay for the insurance policy will increase in value. The goal is to buy them cheap and to sell them expensive. Moving on to strategy number 2, selling covered calls. And this is perhaps the most basic beginner strategy in options. Every stock market investor should familiarize themselves with this strategy. And this strategy works best when we see huge pops in a certain stock that you own. For example, last week we saw a massive pop in Ford. This is a stock that I own in my portfolio, and I kind of talked about that during Thursday's video when we saw unusual activities in Ford stock, and right away you saw the stock popping higher significantly on Friday. So what did I do on Friday? Remember, the goal here is to de-risk if the market turns around and becomes ugly. When we see a massive pop, as we've seen during Friday's session for Ford, call options premiums increase significantly in value. Your goal is to capture that increase in value and pocket those gains by expiration date. What do I mean by that? On Friday, I sold the $15 calls. And by the way, you cannot sell what you don't own. For example, if you own 100 shares of Ford, you can only sell one contract. Because remember, each contract has 100 shares. Now, if you own 1,000 shares of Ford, you can sell 10 contracts, etc., etc. Now, what if you own less than 100 shares of Ford or any underlying stock you're trying to use this strategy with? You cannot use this strategy. This strategy works if you have 100 shares minimum, but you can use the previous strategy of buying puts. You can buy as many contracts as you want, puts or calls, but you cannot sell what you don't own. Enough said. Here's what I did with Ford. I sold the $15 calls expiring in June. And the goal is for the stock not to reach $15 or more by the expiration date, meaning my expectations are that the stock will either consolidate or trend downward. But what if the stock continues to blast higher, closing above $15 by expiration date? The worst case scenario, right? Well, the worst case scenario, if the stock closes above the strike price by expiration date, is you're gonna have to sell your shares at the strike price. In this case, I will have to sell my shares at the strike price of $15, meaning I will still make money. And therefore, selling covered calls is the best strategy to start learning how to trade options because it is pretty much consequence-free. If the strategy works, you make money. If the strategy doesn't work, you also make money. And once again, I'm using this strategy as a de-risking strategy, meaning let's say Ford drops 10-15% from this point on, and we get the expiration date, June. I will collect the premiums. All of these premiums I sold on Friday, I will get to pocket those. And then I can use that money to buy the dip in Ford. I hope that this is clear. Now, you can combine strategy number 1 of buying naked puts and strategy number 2 of selling covered calls. And this is the beauty, by the way, of trading options. In this case, I sold the $15 calls in Ford and I bought the 11 puts, all expiring June 14th, meaning that I sold the $15 calls, used some of that premium to purchase insurance, in this case the $11 puts, and therefore if Ford collapses all the way below $11, I am protected from that downside. Anything below $11, I am protected. And the beauty of this strategy is that if the stock goes higher by expiration date, I make money because either I'm going to sell the stock for $15 or I get to collect the premium from selling those calls if the stock closes below $15 by expiration date. On the other hand, let's say the stock goes down, and in this case it doesn't matter if it goes down to $12, $11, $10, it doesn't matter. Either way, I will make money. If it goes down to $12, then the premiums I collected from selling the $15 calls will still be here. I will get to capture those. I am still making money. But if the stock goes below 11%, I am also protected by the puts I purchased, and I will still make money. Now, what if the stock goes sideways, nothing at all the way till expiration date? I will also make money because I will book the profit from selling the $15 calls minus the amount I used to buy the $11 puts. So once again, using the strategy, combining buying naked puts and selling covered calls, whether the stock goes up, down, or nowhere at all, I will still make money. Now, let's move on to strategy number 3, which is selling puts. Not buying naked puts, selling puts. This strategy works best if the stock already broken down. For example, I own the stock of CarMax, the ticker KMX. The stock is down about 20% or so from the highs. What does that mean? Put options premiums are elevated because the stock is down. So this is the inverse situation with Ford. With Ford, you wanted to capture the elevated premiums of calls because the stock popped higher on Friday. This is the opposite situation. CarMax is down 20% from the highs and it is down again today. Therefore, the put options premiums are elevated. Now, I want to protect myself from further downside, but I also want to take advantage of the elevated premiums in put options, and therefore this strategy is perfect for this situation. I sold the 100 puts, and this is the level that I will be comfortable of buying the dip from. When you use this strategy, make sure that whatever strike price you're going to use is the exact level that you are comfortable of buying the dip in the stock. In this case, $100. I think that the tailwinds for CarMax are still here, and if the stock goes down to $100, I will be buying more shares, no hesitation whatsoever. And I am using the August expiration date. Now, let's say that there is further downside for CarMax, and the stock drops below $100, but it starts to bottom and rebounds higher right at the expiration date, but it's still below 100. In this case, I will be exercising those options, and I will be repurchasing shares of CarMax at the price of $100 because I know that the stock has bottomed and it is already turning around. Therefore, I will be exercising those options, buying shares of CarMax at $100, and the goal here that CarMax will continue to rebound higher and trade above $100 after the expiration date. Now, what happens if CarMax stock goes down all the way to $100 or below, but it starts to rebound higher before the expiration date? Matter of fact, trading above 100 by the expiration date. What happens then? What happens then is that those put options that you sold will expire worthless for the person who bought them, but you get to collect the credit. You get to keep every single penny that you received in credit from selling those puts. And now that the stock already bottomed and it is trading above 100 by expiration date, you have that credit and you can use that credit to buy the dip in the stock. The last thing to mention is, remember, in this strategy, you cannot sell what you don't own. So if you own 100 shares of CarMax, you can sell one options contract. If you own 1,000 shares in CarMax, you can sell 10 contracts. If you own less than 100 shares at CarMax, you cannot use this strategy. You have to go to strategy number 1 and just buy naked puts. I hope this was not complicated, by the way, and if it is, ask questions. Now, before we start the normal coverage for this program, the last thing I want to mention is an update for the oversold bounces. Remember, a couple of weeks ago, I made a video discussing oversold conditions in certain stocks and how to trade those using call options. It was the tickers festival. I gave you about 50 tickers, and here is an update. Today, I closed the majority of these trades playing the oversold bounces. And here's an example. This is a stock called Plug Power, PLUG. This happens to be one of the retail crowd's favorite names. And of course, the stock is down about 75% from the highs. However, it reached extreme oversold conditions. And a couple of weeks ago, I told you I am buying call options to play an oversold bounce. And this is, of course, a trader's dream because we get these extreme oversold bounces about once a year. So it is an opportunity and you have to take advantage of. What do you know? The stock rebounds higher by the tune of over 50%. Once again, the stock rebounded higher by the tune of over 50%. Now, if the stock is up over 50%, can you imagine the gains on those call options? We're talking over 5,000% gains. So why did I close those call options? Because they've already served their purpose. I don't care if the stock continues to go higher. The likelihood is it will not. And matter of fact, the best case scenario is the stock could consolidate for a little while. Because when you switch to the weekly chart, and this is the difference, by the way, between the short-term scope and the long-term scope, the weekly charts are not oversold and, matter of fact, showing significant weakness in momentum. And therefore, I don't want to hold on those call options any longer and catch a falling knife. You've already made your VIG. Those call options already played their purpose. In, out, hello, goodbye. Matter of fact, now I'm switching to the other side, buying puts, not in this stock, but in another stock that I played an oversold bounce is, and that is DraftKings. And I will show you the trade during the options market coverage. Anyhow, before we start, stick to the conclusion of this video because I have another important thing to show you. With that being said, long intro, but it is informative. So stop bitching and whining. Grab a Kleenex, wipe those tears, and if you still have further complaints about a long intro, make sure you buy your diapers now because diapers are also rising in prices due to inflation. Anyhow, let's start by covering the market performance today. And here we go. The Dow Industrial Average closing in the green by 186.14 points, or a gain of 0.54%. The Nasdaq leading the pack at number 1, closing in the green by 190.18 points, or a gain of 1.41%. The S&P 500 closing in the green by 41.19 points, or a gain of 0.99%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, communication services. At number 2 for the silver, technology. At number 3 for the bronze, real estate. Pretty much every single sector managed to close in the green, so we're not going to shame any sectors today. What about the market breadth? The decline to advance ratio, or the advance to decline ratio, whatever your preferences are. NYSE 71% advancing versus 27% declining. The Nasdaq, and pay attention here, while the Nasdaq closed in the green decisively, the breadth was not that good. 50% advancing versus 47% declining. This is going to be important at some point. Not right now, but in the next few days, if the Nasdaq starts to pull back, now you know. Remember when the Nasdaq was going down, but the advance to decline ratio was not that bad. Now we're seeing the Nasdaq rebounding higher. The advance to decline ratio is usually, not always, a leading indicator. Moving on to futures, what's going on here? We are seeing a big rebound for oil. Matter of fact, the WTI and Brent all closing with gains over 3%. What about softs? We have modest gains for sugar futures, meanwhile declines across the board, led by cocoa futures, and then modest declines for OJ, coffee, and lumber futures. Meanwhile, cotton futures closing flat. What about metals? All in all, a decent day for metals futures with gains led by silver, copper, platinum, and gold futures. The clear outperformance from silver and copper. Copper is finally noticing that the US dollar is declining and it is rebounding higher. We saw a rebound, the big one, for lumber, and now we're seeing a rebound in copper. We're waiting for a rebound in corn. If that is the case, then this whole garbage argument of a transitory inflation goes out of the window because the dips are being bought in futures. The only loser in metals futures today is palladium, down by about 2%. What about meats? Muted day across the board, modest gains for feeder cattle futures, meanwhile modest declines for lean hogs and live cattle futures. What about grains? Also muted across the board with modest gains for oats and soybean meal futures. Meanwhile, noticeable declines of about 2% for wheat. The rest, soybean oil, corn, rough rice, soybean, canola futures, all flat to muted today. Moving on to the big casino, the options market. We're seeing more call options buying. The overall volume remains muted, but the action is heavily tilted toward the upside. Lots of dip buying, lots of bets that the market has bottomed, at least in the Nasdaq and the mania names, and they are buying lots and lots of calls. And in the short term, that is successful in creating many gamma squeezes. At number 1, with about 740,000 contracts, about 63% of those were calls, Tesla. At number 2, with about 680,000 contracts, about 69% of those were calls, Apple, aka the iMob. And the iMob is on trial today. I believe the trial is already concluded. It's the iMob versus the people, represented by Epic Games, Fortnite. And the outcome here will be clear. I mean, the judge and the entire court is pretty much elected and sponsored by the iMob. What do you think the ruling is gonna be? Moving on, number 3, with a little over 500,000 contracts, about 67% of those were calls, Virgin Galactic, aka Space. Of course, Sir Richard Branson and the snake oil salesman Chamath Peloton Tortilla already cashed in. They're done, they pumped, they dumped. And now they're telling you, yeah, we know you're holding the bag, but continue to hold the bag for a little longer because we got more hopium for you. You know, more testing, more promises. Someday we're going to have a flight to space. Put your blindfold on and continue to buy. buy. So Sir Richard Branson and Chamath can start dumping once again. What about the unusual trades taking place in the options market today? Let's start by the ticker BLDP. And this is for Bullard Power Systems. Whatever that is, it is a highly unusual trade because we don't see this ticker often. But here it is, they're buying puts, specifically the 13 puts expiring June 18th. And the expectations are that this name will drop over 20% by then. They paid about 8 cents a piece to enter this trade. All in all, bringing the total to about $370,000. What about the trade for the ticker SPY, the S&P 500? Everyone is having an orgasm today. The market is up big, but here we have a de-risking trade by making bearish bets against the SPY. And they are buying the 345 puts, expiration date June 25th, with expectations that the name might drop over 18% by then, and they paid about 50 cents a piece to enter this trade. All in all, bringing the total to about $1.6 million. This is clearly an insurance trade, a de-risking trade, because it would be a disaster if the SPY drops over 18% by June 25th. So they are hedging their current portfolio. What about the trade for the ticker DKNG, DraftKings? I pumped the name, I bought the oversold bounce, made a killing, because remember, I tried to buy the dips repeatedly in this name, and I ended up losing money. But the last one was a hit, and it didn't only compensate me for prior losses, but I also made a significant gain, and therefore I closed that trade today. And I am using a portion of my gains to follow this trade by buying the 40 puts, expiration date July 16th, with expectations that the name will drop over 18% by then, and they meaning me, paid about $1 a piece to enter this trade. All in all, bringing the total to about $2.2 million. And the goal here is, if we see profit taking from other dip buyers, the name will drop 3-4%. Right there, I will be booking profits from this trade. I'm not waiting for it to expire in July. Similarly, here is another trade that I followed for SPCE, Virgin Galactic, Chamath Predatoria. Hello. The name popping higher, significantly higher, and the pops started last week and continuing today. But the likelihood is we will see some profit taking, bag holders reassessing, saying perhaps I should use this pop to exit, fade the pop. We're not talking about the hoodlers, by the way. The hoodlers are a bunch of morons. They pretty much were born to get slaughtered. But we're talking about somebody who bought the hype, followed Chamath Predatoria, and then ended up holding the bag. Well, this is an opportunity to unload this bag and move on. And this is exactly what I'm betting on by following this trade, by buying the 24 puts, expiration date May 28th, meaning this upcoming Friday. It is a short-term trade. The risk versus reward is worth it. And the expectations are that the name will drop over 10.5% by then. And I paid about 65 cents a piece to enter this trade. All in all, bringing the total to about $1.1 million. I spent millions today on these trades. What about the trade for the ticker TAL, TAL Education? This is a garbage name, one of those Archegos type of trades, and it is extremely volatile, by the way. Down big, but the oversold bounce in this name was also extreme. Perhaps the oversold bounce is over, and now the name will resume the movement to the downside. This is at least what this trader is saying. By buying the 32.5 puts, expiration date June 18th, with expectations that the name will drop over 5.5% by then, they paid about $2.65 a piece to enter this trade. All in all, bringing the total to about $3 million. Now, what about the trade for the ticker MS? This is Morgan Stanley. Usually we don't see Morgan Stanley in this list. But once again, financials are the best names to own right now. I own Goldman Sachs. I don't own Morgan Stanley. And therefore, I am following this trade because when you assess the risk versus reward, it is worth it. And the entry cost is very low. In this case, we bought the 100 calls, expiration date July 16th, with expectations that the name will rise over 11% by then, and we paid about 85 cents a piece to enter this trade. All in all, bringing the total to about $730,000. Moving on to the heat map analysis. Pretty much every single sector in the market closing in the green with very few exceptions. The notable underperformance is coming from the healthcare sector. Remember, the healthcare sector was the safe haven the last couple of weeks when we saw the storm hitting the Nasdaq. Now that the storm is over, quote unquote over, we don't know if it is over or not, but for now we're seeing a massive bounce in the Nasdaq, and the assumption is that the worst is behind us until we receive more economic data signaling that inflation is indeed not cooling off. And the gains in the tech sector are broad-based, whether we're talking about software, chips in particular. But we also have gains in the laggards last week. Tesla, for example, even though we saw bounces in the software names, the high multiple names, Tesla was absent from participating during that bounce last week. But Tesla's finally participating because it has an oversold bounce of its own. And remember, today was a good day for Bitcoin. And by the way, this brings me back to the intro of this video, the danger ahead with the market being associated with Bitcoin. What if Bitcoin breaks the support of 30,000 and starts trading below that, 20,000, 15,000, 10,000? What will happen to names like Tesla, Square, which was up big today, along with PayPal? What will happen to these names, in addition to the chip sector? By the way, chips are rebounding higher along with Bitcoin. And last week, when we saw Bitcoin dropping, we saw a lot of pain for the chip sector. Now, your beloved media, CNBC and the likes, attributed the gains in the chip sector today to the chip shortage. But absent of that conversation is the association between cryptos and the chip shortage. One of the biggest contributors to the chip shortage is the rise of cryptos, because that is increasing the demand, and the chip industry is traditionally accustomed to provide these chips for electronic manufacturers, automobile manufacturers, etc., etc. They're not accustomed to the crypto mania that came out of nowhere, and the rise of cryptos, the mining, is increasing the demand for chips out of nowhere, and suppliers were not ready for such a surge in demand. Meaning, if Bitcoin recovers and starts to trade higher again, we will see these chip names also recovering higher. However, if the pain in cryptos, and Bitcoin in particular, resumes at some point, you will see these chip names dropping lower once again. It is a very dangerous association because it is not just Tesla, which is one of the biggest names in the Nasdaq and the SPY. It is not just PayPal and Square and ARK Invest, all big major names in the market, but it is the entire chip sector. This is a very dangerous development, and nobody's talking about it. If the chip sector goes down along with Tesla, along with ARK Invest, along with PayPal and Square, in association with a drop in Bitcoin below 30,000, perhaps down to 25,000, 20,000, 15,000, the crash in crypto will create significant ripple effects in the stock market, and therefore de-risking is extremely important right now. Moving on to the themes analysis, what about the reopening trade? All in all, rebounding higher along with the market. We have an excellent day across the board. But once again, try to avoid retail, because retail stocks, the likes of TJ Maxx and Macy's, already made significant gains and went ahead of themselves. And now you're seeing lots of profit taking in these names, meaning that there are two phases of the reopening stocks. Phase number one, which probably ended not so long ago, the phase of recovering retail spending. And now that we don't have any more rounds of stimulus, that tailwind is gone. But the tailwind is shifting toward experiential names in the reopening stocks. The likes of Royal Caribbean, cruises, hotels, casinos, concerts, Live Nation, even amusement parks. You have Six Flags here. These are the names you want to stick with. Retail, restaurants, product-based reopening stocks. Perhaps the tailwinds are shifting away from these names. And by the way, a perfect name to play the reopening trade is American Express. And the reason is it is a bullet stock. Suppose you buy Royal Caribbean or Norwegian Cruises. What if that particular name has bad news and it goes down? Now you're suffering losses. But if you buy American Express, guess what? They're going to book cruises, airlines, hotels, trips using Amex cards. So this is a perfect bullet stock for the reopening trade. What about the inflationary stocks? Also rebounding higher, not significantly. These names are still under a correction, but the question is, are we starting to see a bottoming process? because a lot of these names are tied up to commodities. And we are seeing a bottoming process in commodities. For example, Alcoa is tied to aluminum prices. We saw a significant drop in aluminum, but that is starting to rebound higher. Likewise, copper. We saw a correction with copper for Freeport-McMoRan, but now copper prices are also bottoming and starting to rebound higher. Oil was down big, and you saw a lot of pain for ExxonMobil and Chevron, but now we have oil prices rebounding higher, and the question is, was that the bottom for ExxonMobil and Chevron? We will see higher highs from now. Too early to say that the inflationary trade is bottoming. We need a few more days of gains, just like this, and we need to see some technical signals of a bottom. What about the disinflationary trade? The high multiple names specifically, rebounding higher big. Some have oversold bounces, some riding higher with the movement in the Nasdaq and the movement in yields. Yields dropping below 1.6 today, at some point at least, and that is good for these names because tampering inflation expectations is what they're looking for. You're looking at big gains for names like Snapchat, Shopify, ARK Invest, Tesla, DoorDash, Nvidia. The question remains, will these bounces be short-lived? Because the weekly charts for the majority of these names are not looking so good. We will see. Moving on to the charts analysis, starting with 30 minutes chart of the SPY, the S&P 500. Last night, we talked about a potential of a bearish formation in the SPY from a 30 minutes perspective. The level of 417.30 appeared to be a sticky level of resistance. We saw somewhat of a head and shoulder formation combined with a bear flag formation, a rejection candle from 417.30. But guess what? You can throw technical analysis out of the window if you gap higher overnight and meet very little resistance during the trading hours. This is exactly what happened today. Gapping higher, to hell with all of these technical signals, who cares? And riding higher all the way to stop at the resistance of 420. Because, 420 is too high. Now, remember this. These bounces higher, these gaps overnight on very low volume during the trading hours, these don't last for a long time. We've seen them over and over and over again. They're always met with a nasty flush down, closing the majority of those gaps on the way higher. The problem is we don't know where the overnight gapping will take us. What is the destination? For now, we have a resistance level of 420, so we'll work with that. But beyond that, there is no other resistance level, meaning that the SPY might indeed ride all the way to all-time highs. So long as the volume remains low and the economic calendar is muted and not producing any more surprises. And that could be the story all the way until Friday. Now, looking at the RSI level, and this is a 30 minutes perspective, by the way, so you have to keep that in mind. Every time the chart reaches this level in the RSI, we see a pullback. It doesn't have to be a nasty pullback, but it could take us down all the way to 417.30, retest that level for support because we did not give this level the respect it deserves. The chart gapped higher overnight, pretty much not paying attention at all to 417.30. So perhaps going back all the way down there, retest for support, and then we'll take it from there. Can we have more clarity from the daily chart of the futures? Perhaps, because we had a wedge consolidation and we were waiting for the conclusion of this wedge consolidation. Now we have the answer. The pop is to the upside, and we have a positive divergence in the RSI. Pretty soon, if we have another update tomorrow, you will see that negative divergence being broken. Likewise, we have a curling upward in the MACD indicator, and one more big day to the upside will result in a crossing, creating great impressions in the histogram, meaning that the momentum is turning around in the SPY chart from a daily perspective, from bearish to bullish. The problem is it is too soon to conclude that, meaning we need another big day to the upside tomorrow to confirm that the momentum is indeed changing from bearish to bullish, and this is not a bull trap. What about the Nasdaq 30 minutes chart? Also gapping higher, capturing the support level of 330.5, but it closed short of closing the gap, as you can see illustrated from the yellow line. And that is around the level of 334. It is not a big deal. You cannot conclude one way or the other that this is good or bad because we don't have a reversal before closing the gap. We have some profit taking by the end of the day, but this does not constitute as a reversal. A reversal will be a down day tomorrow for the Nasdaq, and once we breach the support of 330.5, that will be a bad signal that the Qs indeed reversed before closing the gap, and that could take us down all the way to the center of gravity of 323. But once again, this is a 30 minutes perspective. For all you know, the chart could go down to 330.5, recapture that support once again, bouncing higher, closing the gap. And therefore, we need to look at the daily chart and see what it says. The daily chart made significant repair to the technical damage from a daily perspective, and the sentiment indicators are turning from bearish to bullish. We have the negative divergence in the RSI that is being corrected, and now we have a positive divergence. Likewise, the MACD indicator, we already have a successful crossing from 1 day. We're waiting for confirmation, but we are starting to see green impressions in the histogram. Very tiny, too early to conclude anything, but once again, if you shorted from the first crossing in the MACD, perhaps this is the time to close that short if you haven't closed already. You should have closed already the moment you saw the oversold bounces. And you also shouldn't be picking a top for the rebound with the assumption that this is a dead cat bounce until and unless you see a signal or a reversal. Absent of that, it is a deadly game. And I am eyeing the level of 13,718, which happens to be the top of the reversal candle. This is the next boss for the Qs to fight. And once again, I am not shorting by buying Qs puts or SQQs calls until and unless I see a clear rejection, a clear signal for a reversal, indicating that this was a dead cat bounce and there is more pain to come. We will know that if you see a rejection from 13,718 and you see the MACD indicator and the RSI curling back to the downside. Then you'll know that this was a dead cat bounce. Moving on to the IWM small caps, while the Dow Jones, SPY, and the Nasdaq outperformed today, the Russell managed to underperform. Matter of fact, closing in range, there wasn't a massive pop higher overnight, and the weakness is evident in the IWM. The resistance level remains at 223 and the support level at 218. What about the daily chart for the RUT, the Russell 2000? Nothing is going on here. You know the deal, but we are seeing a slight curling upward in the MACD and the RSI indicator, signaling that perhaps the bulls are gaining some momentum. And of course, nothing is conclusive right now until we see the weekly closing. Moving on to the Dixie, the dollar index. I've been wrong on this chart, expecting a pop only to see the dollar index popping for a day or so and then reversing to the downside once again. But I am still waiting and waiting and waiting for a pop higher. These pops happen to be transitory, and I am not looking for a transitory pop. The pop I'm looking for is one that will take us all the way to break the resistance of 91 and beyond. Of course, the long-term trajectory for the US dollar is downward. And by the way, the Federal Reserve is shitting their pants right now looking at this chart. This is, after all, their beloved dollar, and it is crumbling before their eyes. But of course, you can blame the printing, the cocaine operation for the demise of the US dollar, because breaking 90 and continuing that downward momentum will mean that the US dollar will erase the entire pop from 2014-2015. But the Fed cannot have their cake and eat it too. Do you want the cocaine operation, or do you want the US dollar to firm? For now, I am looking for the US dollar to pop higher hand in hand with the resumption of the correction in the market. But if that doesn't happen and we see the chart pulling away from the level of 90 to the downside, this will have huge implications for the stock market. On one hand, you will see copper, gold, silver appreciating significantly. You will also see major exporters, names like industrials and consumer defensives, gaining significantly, because a downward trend in the US dollar helps exporters and those companies that make a lot of revenue overseas. And by the way, one of those names, unusual name, because we're not talking about Procter & Gamble and Mondelez, we're talking about Netflix. Netflix makes a significant amount of revenue from overseas. If the US dollar continues to collapse, then those revenues that Netflix makes overseas will be worth a lot more. Enough said. Moving on to gold, what's going on here? Gold, once again, looks like it is topping. It is running out of steam in the short term, because the long-term charts, the weekly, the monthly, suggesting that the trajectory for gold is higher, and gold just started that move higher. But from a daily perspective, it deserves a break, perhaps going all the way down to 1850. What will trigger this sell-off in gold, profit taking all the way to 1850? It could be a pop in the US dollar or a pop in yields. Do we have any catalyst to pop the US dollar or yields this week? Not at least until Friday. Unless Papa Jerome or some Fed personality opens their mouth and says the wrong thing, then you will see the pop in the dollar and yields taking place sooner than expected. Speaking of the devil, what about yields? Breaking the support of 1.62 basis points. And if that continues, the center of gravity will be 1.55 basis points. And if yields drop all the way down there, that will come hand in hand with a rally in the Nasdaq and the mania names. So far, looking at the chart right now, Nasdaq bulls have the advantage. And we don't have any catalyst, like I said, to pop yields higher, once again above 1.62 basis points. It has to happen organically in the bonds market until we receive more economic data. What about bond prices, the TLT? This is a weekly chart. We are starting to see a small baby gathering in momentum for the MACD and the RSI indicators. It is not strong enough, and this is not what bond bulls want to see. You want to see that massive oversold bounce happening, just like we saw with the mania names and some NASDAQ names. You want to see that big pop, 2, 3, 4, 5%, creating a short squeeze. Absent of that, all of what the chart is doing is correcting some oversold conditions via consolidating before resuming the move to the downside. So for bond bulls, once again, you want to see a pop higher. You want to see the TLT recapturing 140 by the end of the week. And the line in the sand is 134.5. You don't want to see the chart breaking that level from a weekly perspective. What about the VIX? The SPY breaking higher, the VIX collapsing below 20 once again, losing some momentum from a daily perspective, but once again, the weekly remains intact. And this is the mystery, by the way. Are we being fooled by the daily move in the SPY on very low volume, as the weekly chart of the VIX is suggesting, or is the move higher in the SPY credible, and the VIX is just playing tough, but has nothing to show for? And we will see those weekly charts on the VIX correcting and losing momentum as well. The threshold remains 20, and we are eyeing the weekly closing because the daily charts losing momentum, but they're not saying anything at all. The weekly chart is the one to watch for the VIX. Moving on to Apple, what's going on here? Apple moving higher. This is the trial optimism. They're betting that Apple will win the verdict, and that is the assumption, by the way, because if the judge decides to award Epic Games and Fortnite the win, that will be a massive surprise. Not just for Apple, by the way, but it will also take down Google and Facebook at a minimum, if not the Nasdaq entirely. So the verdict for the iMob versus Fortnite is extremely important. For now, according to the technicals, we have one gap already closed, and the chart is pretty much consolidating around that level, at around 127, which happens to be a soft level of resistance, not significant at all. The significant levels are 131, that is the significant resistance, and 125, this is the significant support. For me, the center of gravity remains 120 until and unless Apple recaptures 131 for support. And by the way, we're seeing lots of call options buying in anticipation of the verdict. And if we get the verdict this week, that could create a pop, a gamma squeeze, and Apple will easily recapture 131. So the iMob versus Fortnite, this is one to watch. What about the souffle, Tesla? Souffle is bouncing higher, without me, of course, because I was waiting for 540, and I was very conservative. But if you bought the dip above 540, and by the way, the chart went down all the way to 545, 548, so it was extremely close to the level I was watching. Anyhow, the next thing a trader should watch for, assuming you missed the pop, is the potential for a reversal. Where will this pop, this rebound stop? Number one, we have the gap at 629, which happens to be the bottom of the reversal candle. This is resistance level number one, but the ultimate destination will be 679. Now remember, 622 will be very difficult for Tesla to cross, but if it happens to do that successfully, then we're looking for 679, which happens to be the line in the sand, and that will be pretty much close to impossible for Tesla to break on one shot before reversing and gathering support from a lower level. So once again, if you missed the boat to the upside by buying calls, you can wait and anticipate a reversal at 629 or ultimately 679 to hop back on the short side. What about the tulip market? Because this is where the story is. Massive declines over the weekend, but yet again, a massive rebound higher today. And the power to shape the next destination for Bitcoin and cryptos isn't on the hand of hodlers. Hodlers are already all in. They're not buying the dip with very few exceptions. Those who are buying the dip, waiting on the sidelines, are sitting on the driver's seat. The first dip buyers were extremely greedy, as they should be, by the way. They bought the dip at 30,000 and they dumped at 42,000, following the technicals. Extremely smart and pragmatic traders. In, out, hello, goodbye. We're not in love with Bitcoin, we're just trying to make money. If this new batch of dip buyers are thinking the same, that hey, buy the dip at around 30,000 and this should be a quick flip, quick profit, then watch out, because the oversold conditions will be worked out in BTC and then we will see the pain resuming once again. I wouldn't feel comfortable with this chart and assume that Bitcoin is out of the woods until we see 42,000 recaptured and retested for support. Absent of that, for all you know, the pain will resume once again. What about Doge? Nothing is going on here with Doge. We're seeing pops higher in empathy with the rest of the crypto market, but once again, Doge is dependent on tweets from Elon Musk. We're not seeing tweets anymore, at least not today, but switching to the daily chart of Doge, are we seeing a head and shoulder topping formation? This is the assumption, and Doge will go down all the way to less than 10 cents once again. But remember, technical analysis is one thing and Reverend Elon's tweets are another when it comes to Doge. And therefore, these are not reliable investment vehicles, because when the technicals don't work and somebody else's tweets work instead, forget about it. You cannot say that Doge is a reliable investment. It's a joke. It's funny if you have extra money and you don't know what to do with. I mean, there are people still waiting on food lines, homeless. You could donate to these people instead of playing with money. But again, it's your money. You want to play with it, go ahead. But it is a game. It is not an investment. What about Ethereum? Ethereum looking a lot better than BTC, which was contrary to my expectations, because BTC is oversold, ETH not that oversold. But it is rebounding higher and recapturing a significant level of 2,500. The next challenge is recapturing 2,900. And the level to watch for is 2,000. You don't want to see ETH breaking 2,000 once again. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the Consumer Confidence Index, and we have some information and data regarding the housing market. We have the CoreLogic Chiller, which is going to be very important because it is a year-over-year change. And we also have new home sales data. So lumber futures will be important to watch tomorrow. Lastly, let's talk about this from the Wall Street Journal. The performance of stocks, commodities, treasuries, and tips during different scenarios of inflation, going all the way back to 1973. When inflation is high and rising, you see commodities outperforming. Meanwhile, stocks and treasuries lagging. When inflation is low and rising, stocks overperform while you see treasuries lagging. If inflation is high and falling, aka transitory, then you see treasuries starting to outperform. Meanwhile, commodities starting to underperform. If inflation is low and falling, then commodities is the significant underperformer. Meanwhile, treasuries and stocks overperform. And this is the environment we've been seeing for years and years now. So, according to this, where are we now? Let's see. Here is the performance for the commodities index, the USCI in red versus the SPY in white versus TIPS in green, and the TLT representative of treasuries in blue. This is year to date, by the way. As you can see, commodities are outperforming with gains of about 19.5% year to date. Meanwhile, the SPY, the stock market, is doing okay, not bad at all, but lagging commodities with gains of about 10% year to date. Tips flat, and we know that tips are manipulated by the Federal Reserve. Meanwhile, treasuries are the underperformer year to date. So going back to the study, where are we now? When commodities are outperforming, meanwhile, stocks and treasuries in specific underperforming. This is an era of high and rising inflation. Is the Fed paying attention, by the way? Of course not. The Fed says we don't see inflation. And by the way, we're not talking about anything. We're just brainless zombies waiting for the disaster to happen first, and then we will react to it, opening the risk for being too late, and therefore de-risking your portfolio is extremely important. Anyhow, that's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.